The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
An almost one-for-one flip-flop out of small caps and in to big tech. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. So that NVIDIA break was short-lived.
Yeah, we kind of knew it was going to be short-lived, a 3-day drop and entry point for a lot of folks today.
Yeah, all right, so let's get to where we are within the market. So it is that NVIDIA rebound. You have the S&P up by about 0.3%. Obviously, tech is outperforming as NVIDIA moves over 5% higher. Now, digging in a little bit, though, we do have FedEx after the closing bell, and transports overall, the Dow transports are getting hit down by about 1% there. So that's interesting, too, as we had continued into some of those earnings seasons. And the Bitcoin. Bitcoin is up by 4%. I don't know if you saw this, Romaine, but the correlation between NVIDIA and Bitcoin is actually like 0.4 right now over the last 60 days. They're kind of moving in tandem, and I wonder what that says about that risk-on appetite.
Yeah, absolutely. Definitely a barometer for that risk on appetite and maybe a barometer for the broader market as well. In fact, the best performing major market in the world, showing exactly why it remains that resiliency. A bounce back in the NASDAQ after 3 days of losses. Chris Montague over at Citi saying the tech heavy index remains the most bullish of all of the markets out there. Steve Eisman over at Neuberger Berman says stop obsessing over valuation. It's a death wish, he says, as that NVIDIA AI narrative is a multi-year story that's still intact. Excuse me. And that multi-year AI story has been the talk of the Bloomberg Invest Conference, a 2-day affair taking place right now in New York City. Philippe Laffont, the Tiger Cub founder over at Coatue Management, giving a rare public interview on the main stage this morning. Here's what he had to say about where to look for the emergence of winners in this AI steeplechase.
At the beginning of these new waves, the new winners 10 or 20 years out, some of them are existing companies and some of them are new. But the new ones that get big, there's maybe one a year, no more.
We're going to show you a lot of highlights from that conference, but there was a report out earlier today by Synergy Research Group that says one of the unlikely winners in this AI race could be the debt markets. A fresh report saying AI is accelerating digital infrastructure growth, with global spending on data center construction likely to top $55 billion by 2030. And most of that money, at least according to Synergy, will need to be financed through the asset-backed debt markets for financing.
All right, well, let's get more of that interview with Philippe Laffont, a Coatue management founder and portfolio manager, and get his take on investment outlook as well as strategy from the Bloomberg Invest Conference.
Short run, it's true that the mentions of AI in every TV and written form is very high. And so one could say, wow, if everybody talks about it, it must be priced in. And the only reason why I'm more positive is I remember when I invested in Apple in 2009 when the iPhone first came out. And for years, people told me, why are you invested in Apple? Everybody talks about Apple. And obviously, it had an incredible run. So I actually think that sometimes because someone speaks a lot about something, it might be actually a good sign versus the overhyped sign.
Now, some people on Wall Street say the best way to invest in AI is go invest in the big companies that are already doing AI, Google, Facebook, Microsoft, and so forth. Others say go find the smaller companies that might grow into the next NVIDIA. So what is your own view?
I'm conflicted. On one hand, the history of technology seems to be that the big get bigger. But also, sometimes out of nowhere, a new company gets created, like Facebook or TikTok. And at the beginning of these new waves, the new winners 10 or 20 years out, some of them are existing companies and some of them are new. But the new ones that get big, there's maybe one a year, no more.
All right, let's suppose I say I missed the AI wave, I wasn't smart enough to get there, but there's another technology wave always coming along. So what's the next technology thing I should invest in if it's not AI? What's coming behind AI that is going to excite tech investors?
Two things. One is if you peel the onion of AI and you think about all the building blocks necessary for AI, you might stumble on real estate with data centers or utilities with power. I find the power is really interesting. So it shows that before I answer the new, there is a sort of an onion effect and you can peel it. There's a lot going on with AI. On the new thing, AI is sort of going to be this amazing sort of artificial brain. What I wonder is what happens when you put that brain inside of a robot and we humans need to then live side by side with humanoids. I'm like, wow, I don't know exactly when it happens. Maybe it's 10, 15 years. Musk says it's 5, other people say it's 25. Take the average, 15 years. That's going to be pretty exciting.
The founder of Coatue Management there, Philippe Laffont, speaking over at the Bloomberg Invest Conference taking place, Alex, over the next 2 days here, right down in Lower Manhattan. I know you had a chance to get down there a little bit earlier for your radio show here. I mean, there's a lot of talk about technology down there, as I guess would be obvious, because it's just an AI world and we're all just living in it pretty much.
Yeah. Yep. And also, the private market too, right? All the startups that aren't startups anymore, but have really grown, that don't have an exit strategy yet into the public markets, but clearly they're not the way they were back in 1999 or anything like that. Like they have money, they have a product, and they're all really based around, say, chips or the storage. And sort of when that market opens up to really bring more of these companies to the public. That was also
that was a big part of the conversation. And, of course, another part of the conversation is, of course, going to be about, I guess, financing all of this. I mentioned a little bit earlier that report out of Synergy, this idea here that a lot of money, of course, needs to go into this stuff, and you have to raise that money. We had a chance to catch up with Todd Boehly. Sonali Basak sat down with him a little bit earlier, and he really talked about this idea of growing his firm, his private credit firm, into a much bigger deal, a new firm with at least $65 billion in assets in the next year that combines a number of businesses at Eldridge Industries here. This idea that he really wants to be all things to all people. Listen to what he had to say to Sonali a little bit earlier.
I don't think that the boom in private credit all of a sudden suggests that private credit is bad asset class, right? We're seeing a general debanking going on, and the credit sources are transitioning, into, frankly, less levered holders, right? So if you look at the BDCs, right, the BDCs are a lot less levered than banks. So I think it's a lot safer for systems that are moving credit into lower levered institutions than traditionally where they were formed. But we think there's a big opportunity in credit. And what we want to do is just be all things credit, in partnership with our insurance company.
I want to talk more about credit for a moment, but really recently in the market, it was very widely reported that you were looking at buying a fairly sizable private credit firm out of Europe. That firm, we've reported, has gone off to seek potentially a management buyout instead. What does this say about your ambition to consolidate the asset management industry? Are you looking at more private credit firms? How large would you make of an acquisition?
Well, I think if you look out there again, there's a lot of these businesses that are somewhere, let's call it between 30 and 50 billion of AUM. And they're trying to figure out what's their growth strategy. And I think in partnership with an insurance company that's growing, scaling, and is reinvesting its capital into that growth, there's a lot of opportunity because the insurance company, as it grows, the asset manager grows, right? So you get the benefit of the scale of the insurance company generating more spread-related earnings, and then you get the benefit of the asset management growing and generating more fee-related earnings. So it's this great combination where through kind of $1 of equity capital, you get two benefits.
So this will anchor, I think, a lot of our discussions throughout the day here. It's a really interesting environment for credit. Interest rates, even if you believe that you'll get one rate cut this year, they're higher than they've been in the last decade. What kinds of opportunities is it creating for you in the credit market more broadly?
So I think there's a couple places that are very interesting right now. I think real estate credit is a good place to be because I think you see regional banks are pulling back, and I think the value of real estate has it stalled out a little bit. So you're going to have to be in a position where you need to refinance these loans, and with SOFR where it is, you're making kind of 9, 10, 11, 12%, on an unlevered basis. So I think those are really good rates of return. We see opportunistic examples, like, for example, we bought $1 billion of loans out of PacWest Bank. When the regional bank tremor occurred, the banks were trying to figure out how do we fortify ourselves, and therefore they're selling assets. And generally the way that works is they sell their best stuff first. So we were able to buy $1 billion of loans out of PacWest, and already roughly 20% of those loans have already refied themselves out. So it was a good opportunity to be well placed and to be able to move quickly. I think another place that we're excited about is this world where there's a bunch of these kind of growing disruptive tech firms that maybe raised money in 2021 or 2022, and they're going to need some growth capital. There's clearly value in the firms based on the fact that other businesses would love to buy them, because I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses. So real estate credit, kind of structured credit, and growing disruptive tech firms, and then opportunistic credit. Because there's definitely going to be some things that go wrong. So to be in a position to be able to move quickly. We're working on one right now where we're buying senior secured debt at 50 cents on the dollar and taking control of a position.
What goes wrong? If you think about the next 6 to 12 months, there's a lot of concern that these prolonged these prolonged interest rates will start to create serious cracks in the market. Where are you starting to see them?
Well, there are definitely places where, there's been, I think, if you look at the liability management exercises that are going on, there's been something like 30 or 35 of them. And 14 or so have been kind of what we'll call repeat offenders, where the borrowers have already done a liability management exercise. So they didn't end up kind of solving their problem. They just kind of kicked the can down the road. So I think it's specific to industry, right? If you go back and you look at defaults ripple through industry, right? So generally there's something going on in an industry. So defaults generally spike, in an industry. I think everyone obviously talks about the real estate stuff. I've never found that anyone has been able to predict the thing that's been the problem, right? Generally the thing that is the problem is a surprise. So, I think we're going to see this sort itself out would be what I would bet. But obviously, I think we're also living in a world where, a 4.25, 10-year people think is high. If you go back and look at time, a 10-year at 4.25 is not high, right? So I think we'll see over time the front end of the curve come down, and the back end of the curve will kind of stay where it is. But I just don't see that the higher for longer is necessarily going to be the thing that crushes us.
Todd Boehly there over at Eldridge, speaking a little bit earlier down at the Bloomberg Invest Conference here in New York. We're going to have full coverage of some of the other events taking place today, including the sit-down in just a bit with Paul Taubman. In the meantime, when we come back, more voices from Bloomberg Invest with Matt Miller and his sit-down with Saira Mailk, the Chief Investment Officer over at Nuveen. Stick with us. This is The Close on Bloomberg.
We are 45 minutes away from the closing bell. Tech is making a comeback with the Nasdaq up over 1%, the S&P up 0.3%. Transportation sector, though, weighing on the Dow Jones Industrial Average, and all because of NVIDIA finally making a rebound after 3 days of losses. Abigail Doolittle joins us now. Abigail, just taking a look, say, at the chart and sort of the move we had today versus, say, the last 3 days, do we have more upside in this move? Like, are we done with the 3 days?
We may have a little more upside, but I would say that the proclivity is mainly to the downside at this point, at least to go sub 100. So it's interesting, this stock has just have this parabolic uptrend, but the most recent piece of it, it's on a gap. And a lot of times when you have a gap, it could be a breakaway gap that suggests that we're just going to keep going. But given the fact that it's somewhere in a 1,000 percentage point move, 2,000 percentage point move, depending on where you measure this thing back from, it's very likely that will fill. So we probably see NVIDIA go back below 100. Does it happen tomorrow? I don't know. They don't report for a while, but we do have earnings season, so there could be some supply chain news. A lot of people now focusing on that price to sales. I think it's at 20 or 30 times. Super rich, big move, so maybe some more chips coming off the table.
So that gap, that's down around like 102 or something based on my Bloomberg. That's a pretty big drop from where we are right now at 125. And it was interesting, too. We were talking about some of the commentary coming out of Invest, and then we had Steve Eisman on Bloomberg Surveillance this morning. He was saying, look, all you little worrywarts, what's wrong with you?
So
and he makes a good point. I mean, I don't necessarily agree with him, but he makes a good point here that we get so obsessed sometimes with these valuations, but sometimes it's not about valuation.
So, it's interesting. I read those comments, and I was actually going to reference it because it is interesting that he says you don't even notice the move down, that, the 3 down days in a row. On the other hand, I noticed the parabolic uptrend, and I noticed that gap. So when you see that move down in light of that parabolic uptrend and that gap, I respectfully disagree that, there is some concern.
Well, you don't have to be respectful about it.
He's a professional, and he's actually known for calling bubbles. So he's saying that this bubble is in fact not a bubble. But, to ignore valuation here, it assumes that the AI craze is going to go on. We just don't know that yet right now. I think that it is. However, at some point, they're just not going to put up the same kind of quarter and guide as expected. But I would say that this is probably more near-term consolidation that is likely to happen to fill that gap.
So something I've been talking about with Mandeep Singh and Anurag Rana, Bloomberg Intelligence, is that the AI chip sector will be cyclical. Like any other chip sector.
Good point.
It's just not quite there yet because there's still so much more demand than supply that we don't actually know how that's going to suss out. Abigail, thanks a lot. We appreciate you for jumping on with us to talk about valuation from NVIDIA. It is day one of Bloomberg Invest Conference. It's taking place today in the heart of New York's financial district. And we want to take you there now with Saira Mailk, she of Nuveen, and Mohammed Al-Sowaidi of Qatar Investment Authority on stage with Bloomberg's Matt Miller.
AI is one of them. The consumer is another. Elections are the third. But I think each one of those opens up a really interesting conversation. So why don't we start with the first one? And I'll start by asking Mohammed, since you contribute the factors, I'll get Mohammed's take on, you're a very long-term investor. You're offering an enormous amount of capital to global markets. I'd love to get your take on AI. Is it just the flavor of the year, or is it something that's really going to drive us, like the internet has, long-term over decades?
It's a great question in a time where there is a lot of buzz about it. But fundamentally, all businesses need to be more efficient. And one of the ways to make human more efficient in their procedures and make companies and make software more efficient is empowering it with AI. The key fundamental thing that happens is the strength of software coped with and coupled with the strength of hardware, which is available now. And that opening up and the availability of data, those three factors getting together and proof of concepts flowing in indicated that there is a big use cases across the industries. So we believe it's a very real thing. In fact, we in QIA, we're a very long-term investor. Very, very sizable as well. We from time to time we assess the long-term themes that we should spend time on, and AI was one of them. A few years ago, we started investing heavily in things like data centers. So in addition to investing on highly volatile or kind of higher risk return businesses that we really like to invest in, we do a lot of investments in those as well. But you could also invest in a lot of things that are more infrastructure-like. And would fuel AI.
So, Saira, how do you look at it? I mean, obviously, we all think about the end user, but also Mohammed is one of the large investors that's going to drive this sector. When you look at it as a CIO, what do you find interesting in terms of, industries that it's going to affect? Software, hardware, where do you look to put money to work?
Well, beyond the traditional AI plays, the other thing about AI is that it works off a ton of data. So these large industries like healthcare, financial services, R&D in healthcare, where there's tons of data, financial services investors like us who can look at our trading data and our client data and look and use AI to make us more productive and more solutions oriented for our clients. I think it's going to be important across a host of broad industries, but like any newish sector, it has its fits and starts. So you've had this period since February 2023, where if we go back and think about that, everyone was worried about a recession last year, and instead we got February 2023, where AI became more widespread and the markets took off. So we've had that period of sort of euphoria, very limited supply of stocks, NVIDIA, Microsoft, not a ton of companies that we can invest in publicly. That's why those stocks have done so well. And now we're seeing a bit of a consolidation phase. You look at NVIDIA, which has been down over 10% in the past few days. But as I mentioned this morning, we're just back at early July price levels for NVIDIA. So this isn't exactly a massive downturn for the stock, but there will be these periods of consolidation where it gets somewhat overbought, but the long-term trends for artificial intelligence, that increase in productivity and revenue boost for companies, I think is here to stay.
Yeah, $430 billion in market cap was wiped out over the last 3 days. I think it's still up. It was up at least when I left the office an hour ago. In terms of the investment opportunities, are you finding more, Mohammed? Because as Saira mentioned, at least in public markets, there are only a few, as you can see by the, the capital formation, there are only a few opportunities that investors can go to.
To add to another point, actually, not necessarily the new market cap created as new opportunities. A lot of that is actually new players eating up legacy existing players. So to answer your question, I think, first of all, we as a long-term institution, we're conducting constantly deep reviews on what kind of businesses we own that could be negatively impacted by the long-term new themes as we see them. So one is looking into how could we readjust our portfolio and mitigate it against some of those themes. AI is one of them. In terms of availability of options, there is the public space where there is few names really that address them directly. But in the private space and some of the public space as well, you find very interesting applications where it's AI empowered. For example, we invested in a business called Radiology Partners. It's basically a medical services business that utilizes AI to make radiology assessments better. For example, it's seen that radiologists, there's not a lot of them, sometimes difficult to find a radiologist on time. So having some software that enables you to aggregate all the know-how and data historical and utilize and make radiologists be able to see 20 scans in an hour instead of being able to see 4, for example. So in addition to finding new hardcore AI, we're looking into other applications that could be empowered by opportunities or businesses that could be transformed with an element of AI.
It's interesting. An interesting tangent to this is public investments versus private. And last year when AI really took off, we also saw an explosion in interest, at least, in private investment, certainly in private credit, even for retail investors. I talked to a guy who was running a platform that was going to allow retail investors to invest in private credit. I thought maybe that's a little bit above their pay grade, but it's happening, right? How do you look at the asset allocation between private and credit in portfolio construction?
Sure. Well, I think the 60-40 equity fixed income portfolio will evolve to a 50-30-20, 50 equity, 30 fixed income, 20% alternatives. Alternatives provide not only lack of correlation with other asset classes, but more diversification from the other asset classes. I think 3 asset classes and alternatives are very interesting: farmland, infrastructure, and private credit. So first, starting with farmland, it's a great inflation hedge. Over the past 30 years, on an annualized basis, land has outperformed inflation by 8.5%. Obviously a key issue these days with inflation staying sticky. Looking at infrastructure, not only the tailwind from building additional data centers and different ways to
Saira Mailk there speaking, the Chief Investment Officer over at Nuveen, alongside Mohammed Al-Sowaidi over at Qatar Investment Authority. This is the Bloomberg Invest Conference you're watching right now, live here in New York City. You can continue watching this conversation and all the conversations to follow by typing LiveGo onto your Bloomberg terminal. Have you invested in farmland?
I was going to say,
Yeah.
I haven't heard that call in about 10 years.
But I feel like everyone's looking for something else, right?
Yes.
I mean, something that's, I guess, a little bit more of a diversifier, something that has a little bit more value. And I'm no expert on farmland, but I guess maybe she's found it,
but
found
it's
some
funny
opportunity
enough,
there.
I heard farmland and MLPs 10 years ago. And
Yeah.
you know what we just heard? Farmland, and guess what I'm hearing? MLPs.
Yeah.
So it's just circular, whatever comes back. But it does feel like at Invest, it's private credit, it's AI. Like those are the two buckets.
Yeah, definitely. So those are the two big overarching themes. More coming out of that conference in just a bit. But when we come back, we're going to have our top calls and a closer look at Gap and its transformation. This is The Close. Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. We're kind of rebounding right now from the NVIDIA loss over the last 3 days. We'll see how long it lasts.
And not just a rebound, but I think it's kind of funny. It's almost like literally like exactly a 1-for-1, like the 0.4% drop that we saw in the S&P, 0.4% gain. Similar story for the drop we're seeing in transports and the rise that it had yesterday, and of course the NASDAQ itself. And I guess all of this is still driven by NVIDIA and AI.
And Bitcoin.
And Bitcoin.
And Bitcoin, same thing. I'm saying
You
there's a
keep
correlation
saying there's a
between the two.
correlation between these two.
If you look at the historical spread over 60 days, you
I
can
know,
see
you
it.
showed the chart. I
No,
believe
I
it.
didn't.
I do.
Oh,
You did,
okay. It is on the chart, but the historical spread chart's cool, and you see the, anyway, 0.4, it's not nothing.
There's a lot of charts on the Bloomberg terminal. Just type it in there, everyone. All right, we're going to get right now to our top calls. This is where we take a look at some of the big movers out there on the back of analyst recommendations. And we're going to start off with the energy drink company Celsius. Truist starting coverage with a hold rating and the second lowest price target on the street at $60. Truist saying energy drink stocks aren't exactly quenching investor thirst amid distribution concerns that will make it difficult for Celsius to gain market share. Those shares down 6% on the day. Next, let's take a look at Penn Entertainment getting cut to market perform over at Raymond James. Takeover rumors abound regarding Boyd Gaming and that letter from activist investors that really did push the stock up to more reasonable valuation in the analyst's view. But he says ultimately, nothing about the business has really changed, and the path to profitability is still uncertain. Shares, though, certainly lower on the day by about 5%. And finally, let's take a look at Capri Holdings, raised to overweight over at Wells Fargo. This is the owner of Versace, Jimmy Choo, Michael Kors, trading well below Tapestry's bid of $57 per share, a sign that investors are still too shaken by that U.S. regulatory challenge to the merger. The analyst says investors have lost sight, though, of how valuable Capri's portfolio is, and says the rewards of owning the stock outweighing the risk right now. The share is getting a modest bid on the day, up by 1.5%. And those are some of our top calls. We do want to stay in the retail space right now and take a closer look at Gap. The share is lower, but they had opened higher here on the day amid a long-term brand transformation that is apparently winning over the folks over at TD Cowen. The firm upgraded the owner of Old Navy and Banana Republic to buy and urged investors to keep an eye out for near-term catalysts that could continue to drive growth. Joining us now for more on that call is Jonna Kim, retail analyst over at TD Cowen. All right, let's talk about this. I mean, a few years ago, this looked like a company that was kind of circling the drain. They got a new CEO. They seem to have found a little bit of cachet. How far along are they in this process right now, Jonna?
Thank you for having me on today. We still think they're pretty early innings of their turnaround. But what we are seeing is encouraging traction at Gap. We're seeing more cultural relevance for the brand, more sustained growth at Old Navy, and a potential turnaround for Athleta in the second half. Athleta used to be an important part of the business, obviously had some issues early on. They comped negative for many quarters. They comped positive for the first time in last quarter since 4Q21. So we are overall positive on the turnaround, and we do think the new management team is different than what the company has seen before. So we're more constructive in the stock today.
So, Jonna, what about their inventory management? Usually, I just think of Old Navy, I think really cheap and super sale. I go to Gap, I look for really cheap stuff for my kid. Is that going to start changing?
Yeah, I mean, we're already seeing, so after sort of elevated levels of inventory across retail, we're seeing a lot leaner, promotions are more controlled, and we're seeing that trend at Gap and Old Navy. Obviously, it's hard to parse out how much is that due to management team or overall industry trends, but we do think management team is very focused on keeping the inventory lean. Therefore, we are pretty confident that they can chase into trends. They have in Old Navy, half of their products are open for buy, which means they can chase the trend. So we are more hopeful that they can be more flexible with their supply chain at this point, and they can lead trend and be more proactive with that.
Jonna, whose lunch is Gap stealing?
Yeah, I mean, it's more of everyone. That I think it's a very competitive landscape. American Eagle, we also cover that one is at the same sort of shopper level. But Gap is trying to be more culturally relevant, both to younger and millennial consumers. So I think it's a little bit of everyone's share, but they've just been very underappreciated legacy brands. So as they continue to find more relevancy, I think they can gain market share today. And also there's a new denim cycle, so that should be a helpful factor for both Gap and Old Navy.
You said a new denim cycle?
Yeah, there's a new denim cycle. People are, coming out of the skinny jeans. They're buying different silhouettes.
Yeah.
And whenever there is a denim cycle, there tends to be more consumer shopping for new products, and that's a nice catalyst for retail.
So am I still behind the times if I'm wearing skinny jeans? Is that what you're telling me? Because I haven't upgraded my jeans in about 10 years here.
Maybe you should go buy a pair at Gap today.
So is this like wide leg? Like what am I going to look like? I'm going to look like Rerun from Good Times?
More wide leg.
Yeah?
Yeah, more wide leg feet. It varies now. I think the younger consumers are going, high rise, low rise, all types of different. So you used to be more single silhouette, but there's a more diversification in the denim, and denim is back. We are seeing a lot of denim on denim trends. So that should bode well for both brands.
I like this trend because maybe then now I can kind of hide some of my bodily imperfections here.
Skinny
jeans just reveals all.
Yeah, no, wide leg's the best. I've been a fan for a couple years now. What happens if we get into a weaker economy? We had consumer confidence data that came out earlier today, and people are still really worried, and they're really worried particularly about pricing, particularly about jobs, etc. In a weaker economy, how resilient do you think Gap can be?
Yeah, I think the Gap brand in particular, we haven't seen a massive pullback from consumers. I think what's resonating in general in retail, when there's newness and exciting items, it catches customers' eye. So we have seen that trend. And as Gap focuses on collaboration and drops, I think Gap is more or less a little bit insulated there. Obviously, Old Navy is more affordable play. We do think they have the benefit of a trade down if there is a consumer weakness. But around the election, there's always cautious sentiment. So that is something that we are watching. But overall, we are seeing newness is a key catalyst for consumer traffic.
So as we get to the next earnings report and the one after that, Jonna, I mean, the expectation, at least right now, is that we're still looking at flat growth on the year, although this will probably be the first year in a while that maybe they didn't have a negative sign in front of that growth here. Can investors really bank on sustained revenue growth?
Yeah, I think this will be a very telling year. We are seeing the comp trends improving across all brands, so that's a very encouraging sign. They are in flat growth implies is due to the fact that they're lapping an extra week from last year. So if we do see the underlying brand trends coming to low single digit plus, I think that's going to give some investors a lot of confidence. And I think what I said before, newness is key to driving traffic. Yeah. And that needs to just happen across all brands. And Athleta is an important piece to this story. If we are seeing a lot more traction there, I think more investors will get confidence in sustained growth trends.
I'm curious just your thoughts on the new CEO, Richard Dickson. I know he's only not even a full year there, but this seems like his strategy's been somewhat quiet, at least relative to what we heard out of Sonia Singhal, and some of the big deals she struck was kind of celebrities, the idea that would bring cachet. We haven't necessarily seen that out of Dickson, and I'm wondering, is this the strategy, is to kind of, I guess, be a little bit more low-key on this, or are we just kind of waiting for him to kind of make those big announcements, those big partnerships? And more importantly, what a lot of us know Gap for from that sort of past heyday was just a massive savviness when it came to marketing.
Yeah, he has made a lot of progress so far. Obviously, we think there's still more room there. His approach seems to be, and it could evolve, but he appointed Zach Posen, a famous designer, to creative director role at Gap and also Old Navy. So there's a lot of cultural relevancy that he tries to create, and I think that is resonating. We are seeing the Gap brand pop up more in people's discussions or social media. So that is definitely a positive indicator that we're seeing of his way of transformation. And the new Athleta CEO as well comes from Alo. So there could be some catalyst there. So we think overall the new management team has done a very good job in a very short period of time. It is something that we monitor the execution going forward.
Yeah.
Hey, Jonna, really appreciate it. Thank you so much, Jonna Kim over at TD Cowen. And we appreciate your time today on that upgrade. Romain's going to talk, but I saw your outfit today.
But do you
I saw your What a Badass shirt. I saw it.
But do you remember the when they had that deal with Kanye West, and it was literally like he just put like garbage bags on the floor, and you had like rummage around to find like, whatever, that puffy jacket.
Yeah.
That lasted what, I don't know, about a year?
4 seconds, yes.
4 seconds, yeah. I don't know. I bought one of those T-shirts for my son. I think he wore it once. It was like $100 or something.
I mean, it's not the best. Wide leg jeans. They're back. All right, coming up, we're going to stay with retail for a second because Walmart's warning about a challenging quarter. I mean, that's in comparison to tough comps. So we're going to dig a little bit into that. We're going to have details in stock of the hour. That's up next on The Close on Bloomberg.
Day one of the Bloomberg Invest Conference taking place right now. Paul Taubman, of course, one of the world's top M&A bankers, right now on the main stage with Sonali, Basak. Let's listen in.
It's higher for much longer, or we're going to start to see the travel back down on rates.
So what you said has a lot of ramifications because at the beginning of the year, many investment banks said there are green shoots. There are green shoots everywhere. Those green shoots are materializing into flowers finally. But it sounds like there could be a real hold through the rest of the year.
Well, we've never subscribed to that. So the good news is there's never been 3 down years in a row in terms of global M&A volume. We've had 2. I think we're quite confident there's not going to be 3. On the other hand, that first year of recovery tends to be reasonably anemic because it's a sclerotic environment right now, and it takes a while to get the transaction flywheel going. And one of the things that is underappreciated and underestimated, Sonali, is there's a bit of FOMO out there, which is M&A is pro-cyclical. If your competitor is making a strategic move, that tends to invite a response. And if your competitor is standing still, your comfort level in standing still remains a little bit higher. So we had always thought that this year might be up 10% plus or minus. It's tracking up 3 year to date. I don't suspect it's going to get a lot better this year, but I think what we are positioned for, as I said, is if we can get past this regulatory cloud, and if we can get the direction of interest rates with greater clarity, then I think you're going to see a reasonably stuck M&A marketplace become unstuck.
Now, private equity, you mentioned it briefly. There's this sense that investors around the world have been giving to us that there is a sense of a liquidity crunch underneath the surface. Private equity firms are not selling assets at the pace they would have liked. They need that money back. They're unwilling to put new money in. What does that look like from where you're sitting?
Well, if you step way back, the alternative space has benefited from a nearly 2-decade environment where interest rates have been near zero. Those are aberrational environments. And then we've seen an almost unprecedented tightening, rate hike after rate hike after rate hike, and that has disrupted the alternative space. So we're sitting here today where a lot of private equity firms are not comfortable selling assets in an environment that's fundamentally different than the environment in which they underwrote the asset in the first place. And I like to say you can either buy assets in a low interest rate environment or a high interest rate environment, and you can sell assets in a low interest rate environment or a high interest rate environment. In that 2x2 matrix, 3 of those 4 are perfectly fine. The issue is when the asset was put on your books in a low interest rate environment and you try and sell it in a high interest rate environment, that's what creates the freezing. And what makes it even more difficult is private equity, which is an industry that has by and large built itself on the ability to control exits, and they have exquisite timing in controlling and finding the right market windows in which to monetize their investments. They're looking at investments put on in a fundamentally different interest rate environment. They see that an interest rate cut is just around the corner, or they believe it to be, and as a result, they have been very disciplined in lightening up and monetizing assets. And because of that, and because so much capital has been called and so much capital has been deployed, Sonali, in the last few years, that there is a very significant imbalance. And it's an imbalance if you've invested through the cycle, and it's an even greater imbalance if you're relatively new to the asset class, because the monetizations that are occurring, by and large, are from the 14, 15, 16, 17 vintages. So if you weren't there at the beginning, you're not even getting those distributions. You're out of whack in terms of your allocations. And as a result, that's made fundraising far more difficult for private equity firms. And it's made them far more judicious in deploying new capital. So you're seeing it in terms of supply. Private equity firms are being far more restrained in monetizing investments. And as a result, they're also being more restrained in new investments. And that's creating a lot of pressure on LPs. And that's why we're seeing a more vigorous desire on the part of LPs to sell and create liquidity within their LP stakes. And we're also seeing more interest on the part of GPs who are interested in finding liquidity mechanisms in individual portfolio companies.
Some of the words you used, freeze, significant imbalance. Ask more simply, how bad is it out there?
Well, ultimately, we get back to equilibrium. What we're finding right now is we're working our way through all of this. And it's just simply the sharp pivot from low interest rates to meaningfully higher interest rates. It's not that interest rates on an absolute basis are so high. It's that there's a meaningful delta between where those investments were made, at what interest rate environment there was, and the current interest rate environment. It's that delta that's creating the issue. And I think what you're seeing is GPs and LPs are finding other ways to create liquidity. GPs are slowing the pace of new investment. They're looking more deeply at ways to monetize existing investments. They're using dividend recapitalization opportunities, fund continuation vehicles, and the like. And we're slowly getting back into equilibrium. So it's not a crisis. It's just simply an imbalance. And it's an imbalance that explains in large part why the M&A market has been so sluggish to rebound, even though CEO confidence, consumer confidence, equity valuations, and the like all would be flashing green. And the reason we're more of an amber environment is because of that. And then leaven in a little bit of regulatory overlay, and it explains why we're off 20% from pre-COVID levels, and we're barely up from year-ago levels.
You know, it's interesting because if you think through for a minute just the pressure that LPs are under and you compound it with the uncertainty that's going on in the world, how are investors thinking through different uncertainties, whether it be the rising geopolitical tensions you're seeing in the Middle East or even the U.S. election here at home?
Well, look, I've believed for a long period of time that the volatility that we're likely to experience in the fall related to the U.S. elections is underappreciated. And I think, starting on Thursday evening, we're going to get people to focus on the fact that with early voting pulling things forward and with the debates moving things forward, that all of a sudden it's going to move from being on the side to being center stage. You then couple that with elections in France, what's going on in the UK and the like. It's clearly a turbulent time. But I think we're going to get past all of that. And it's an uncertainty that the market doesn't particularly appreciate in the US. I think they will. Clearly in France, the investors reacted almost instantaneously to the snap elections. And I think it's just another issue that we need to work our way through. But there's always uncertainty in the world. The fundamentals of the macroeconomic backdrop still remain reasonably constructive. Companies are in changing dynamic worlds, and they recognize that they need to continue to reimagine their companies. And one way to do that is by committing capital, reallocating capital, changing the hand that they have. And as a result, I think people are getting on with it, but it's more complicated today than it might have been 5 years ago.
Now, as PJT, as an investment bank, you have a view that a lot of investment banks don't have because you also have a large restructuring business. You were talking about the private equity crunch, this idea that Sometimes people have taken on debt to try to kick the can down the road. When does that all come home to roost? What does the restructuring pipeline look like?
Well, I don't know if it comes home to roost. It returns to normal, and maybe it overcorrects. Back to my earlier comment, we've had near zero interest rate environment for an extended period of time. That's the bubble. We're back in a more normalized world where capital is no longer free or nearly free. You are in a world where disruption and the pace of technological dislocation, it just speeds up. It doesn't slow down. Every year there are dozens, if not hundreds, of transformative, disruptive companies that are created. You can't have all of that creativity without having some roadkill on the side. You can't have an explosion in new technologies in terms of electrification, decarbonization, digitization, and the like, and have all of these new companies be brought up without others laid low. And I think what we're starting to see is rates going from near zero to more normal levels. We're seeing the quantum of debt continue to explode in terms of how much corporate and public debt is outstanding. We're dealing with the hangover effects from COVID, which severely hobbled many companies. We're seeing many industries be disrupted. And as a result, we expect that default rates and that the need to restructure credit agreements is going to increase appreciably. But again, not to levels that are concerning from a historic perspective, but back to more traditional levels. And I think that's very constructive for our business. I think people have been overly complacent. You see that in credit agreements that in many respects give borrowers a tremendous amount of freedom. They're using that right now to create more runway for themselves. And as a result, it's a companion piece. So I see a world where there's more active M&A, but there's also more active liability management.
Another thing different about you than many of the people that spoke today is you built your own business. You're an entrepreneur, you're a founder, you're almost 10 years into your business. I had covered PJT since it went public, and you made decisions. You made decisions to buy certain assets, get in certain businesses. You started from scratch, essentially. When you look at PJT over the next 10 years, what are the businesses? What are the things that you think PJT can become in addition to what you are now?
Well, first of all, I'm the accidental entrepreneur. I don't think I grew up or at any time in my career thought that I would be sitting here having helped to build this business. But we're incredibly proud of what we've built. I think we're just getting started. We have extraordinary ambitions to create the world's best investment bank. But we have the self-awareness to understand that in order to do that, you need to be extraordinarily patient. And you can't do it in a day, you can't do it in a year, you can't do it in 10 years, but you can be on this journey to build the world's best investment bank. And if it's built around intellectual capital, you need to make sure that you have more intellectual capital than anyone else. And you need to have a culture that invites collaboration and to get people who have different perspectives, different backgrounds, different expertise to come together. And that's why almost everything we've done for the better part of a year has been related to building a unique culture that is all around the client, it's all around collaboration. And as we get more successful, we become more interesting to many people who are at larger firms who see the success we've had and want to be part of it. And we're also seeing that a lot of their clients are gently or not so gently nudging them to firms like ours. So 10 years from now, I expect that we will have more capabilities to follow our clients into more places. So it's important to us to have a perspective on debt markets, equity markets, strategic IR, shareholder engagement, corporate governance, geopolitical advice, and to just continue to expand the breadth of our capabilities so that what's relevant to the C-suite is something where we have cutting-edge capabilities. And it's a process, and we're trying to work through building out all of what we need.
It's interesting you're saying this about hiring as well in this environment, because you think back to the global financial crisis, post-GFC, boutique investment banks started to pop up, and the talent draw from the big banks was meaningful. How meaningful is it today?
I think that door was kicked wide open as a result of the financial crisis, and I don't think there's anything that can close that door. If you go back to the global financial crisis, I think the brand value of the big firms was de-emphasized. I think many of those firms found that they no longer had the same command in corporate world that they did previously. I think increasingly boards of directors and decision makers were focused on the brands of individual bankers and less about firms. The conversion to bank holding companies for some of the last remaining investment banks created more regulatory oversight and the like. And there was that door that was kicked wide open, and through that was an exodus of talent that migrated from large firms to smaller firms. And now you've got this flywheel going where the more talent is embedded in smaller firms, the more likely it is for clients to want to work with more focused firms where advice is the main event. The more success that smaller firms have, that then invites more interest in smaller firms. And I think we're at an inflection point where big firms and small firms will coexist. And there's always going to be different horses for courses. But I think what really has changed is that increasingly clients, sophisticated clients, are looking first to smaller advisory-focused firms, whereas 10 or 20 years ago, it was the reverse.
I'm curious about your ambitions in hiring as well. You know, I've seen you really lean into the hiring market in the past year when a lot of firms have pulled back. How ambitious are you? Is this a matter of being greedy when others are fearful?
You've said it well. The reality is that in a bull M&A market where everyone is chock full of assignments and they've just...
You're watching Paul Taubman right now, the founder, chairman, and CEO over at PJT Partners, live on stage at the Bloomberg Invest Conference in Lower Manhattan. That conference continues. You can type live go on your Bloomberg terminal, continue listening to what they have to say as we return to our normal coverage here, counting it down to the closing bells. Romaine Bostick alongside Alex Steele, joined as always at this time by Scarlett Fu. And Scarlett, an interesting day in the market today, a big flip-flop from what we saw yesterday.
Yeah, it's like we've resumed going back to the normal play of things, which is NVIDIA goes off to the moon. There was a bit of a breather for the last 3 days, and people were really wondering if this was a reset, but it doesn't appear to be so.
Nope, and you heard that all. It was like AI and credit. Like those are the two things at Bloomberg Invest, and the different ways you want to play AI, etc. So it's hard to know sort of when that reset would really be.
Yeah, I was looking at the biggest gainers in the S&P 500 today. The top 5, basically 2 chip stocks and 3 cruise lines on the day. We'll get to the individual movers in just a second as we walk you through the numbers. As I said, this is almost a one-for-one flip-flop of what we saw yesterday with the Dow Jones Industrial Average down almost 300 points or about 0.8%. The S&P 500 higher by about 22 points or 0.4%, while the NASDAQ Composite is going to finish out the day higher by about 1.3%. The NASDAQ 100 up 1.2%. And back to the downside again, some softness in those cyclical and transport names as we actually wait for FedEx after the bell. Dow Transport's down 0.8%. The Russell 2000 down about 0.4.
Yeah, but the bias was definitely to the downside, at least when you look at the number of advancers versus decliners in the S&P 500. 387 decliners, 113 gainers. You look at the IMAP, and it kind of shows what a mixed trade it was overall. Let's start with the red parts of the pie. Real estate investment trusts and materials each down by at least 1%. Utilities losing almost 1%. But you do have strength in communication services and tech. And really, that is NVIDIA, for instance, boosting the tech group overall. And energy stocks finishing modestly positive, about 0.1% gain.
Yeah, and taking a look at the bond market, guys, honestly, nothing really exciting happening. We did have a 2-year auction that went down pretty smoothly, and we get 5-year tomorrow, $70 billion, and then Thursday we get 7-year at $44 billion. So there is a lot more supply to come, but markets really taking it in stride today.
Really taking it in stride, indeed. Let's get some insights out of Ellen Hazen, Chief Market Strategist over at FL Putnam here. Ellen, great to have you here. I don't really know what to say here. This is basically an NVIDIA-driven market. It has been all year. And despite the previous 3 sessions, I think today reminded us of that once again.
Absolutely. We were talking about this last night. NVIDIA was down 15% just in a few trading sessions. It hit some technical levels where we saw support. We saw support at 117. We saw support again at 107 and 101 if it went down that far, which it didn't. And it bounced right back up. So I think that what you've seen is that with NVIDIA, the story is still there. the estimates are still there. This was really a valuation exhale, which is fine. It's completely healthy. And as you were talking a second ago about some of the names that were up today, it's other companies that are also tied to the data center build out and to NVIDIA. So I think it really was a pretty sharp reversal, partly determined by technicals.
Yeah, that's definitely one name that we'll continue to watch. Another name that we're watching, Ellen, of course, is FedEx, which will be reporting in a couple of minutes. As a member of the Dow Transports, we saw a little bit of a rotation into some of those beaten down transport names, but not enough to convince us that we've turned the corner here. What kind of information are you looking to glean from a company like FedEx when it comes to the state of demand, the state of the global economy, and especially the state of industrial manufacturers?
Well, many of the transports have had a pretty tough year, FedEx among them. So as we're watching the earnings, which will be out shortly, as you said, we're looking for any ability of pricing. We're looking for volumes, and we're looking for fuel pass-throughs or fuel surcharge pass-throughs to understand how the change in oil is going to end up impacting those companies. But I do think the transports are a little bit of a difficult place to be right now, as the industrial economy has been better, worse. It hasn't been a clear positive this year, except, of course, for the data center build out.
Well, here's a headline for you guys. Volkswagen is going to make a $5 billion investment into Rivian. Rivian and Volkswagen are to have a JV for the next generation electric vehicles. I find this so fascinating because you have Rivian, you have Lucid, you have Tesla, really epitomizing what an EV play is, and the traditional car makers trying to do it at scale and profitability, which they continue to struggle to do. So again, that headline breaking that Volkswagen planning to make a $5 billion investment into Rivian. That JV will develop next generation electric vehicles. Rivian shares up a whopping 15% post-market on that news. Hey, Ellen, just talk about, the AI trade for a second. What are your derivative trades here on this?
Well, clearly there are other areas within the semiconductor space. So we've liked Lam Research for a long time. We like TSMC, of course. We like ASML. But then if you go a little bit farther afield beyond the semiconductors, we also like a company like Vertiv, right? They're that Emerson spin out from a few years ago. They focus on thermal controls, and they had orders up 60% in the first quarter, which is highly unusual for any kind of an industrial company. So another area you can look at is Constellation Energy, right? Mm-hmm. Stock is up 80-90% this year, again, because of the power needs that are going to be there. So I think you can go a little bit farther afield, but the core is certainly in the semiconductor space. All right, we have to interrupt the conversation. In conversation with Ellen Hazen right now. She's sticking with us over at FL Putnam. Meanwhile, FedEx results are crossing the wire right now. I'm going to start with the forecast for the new fiscal year that we're in right now, 2025. The company seeing adjusted EPS of $20 to $22 a share. The street on average is looking for about 21 on average here. The company also saying that revenue will be in the low to mid single digit percentage growth range here. You're seeing the shares get a nice pop up about 7% here in after hours trading. I just want to walk you through a couple of other numbers as we round out the year. This is the quarter that just ended in the end of May here. The company, let me just give you the full year numbers here. They're closing out fiscal 2024 with about $22 billion in reported GAAP revenue, operating income of 1.56 and net income of 1.5. All of those numbers, guys, pretty much in line with estimates, and $5.94 on a diluted EPS basis coming in above street estimates.
Yeah, talking about the President and Chief Executive Officer talking in the release, saying the results are unprecedented in this current environment. And again, with the initiatives that they're working on in terms of dealing with consolidating its express, ground, and services unit as well. They do say they expect momentum to continue in the fiscal 2025 as they try and continue with their flexibility.
Cost cutting remains the big theme here for this company, and you see that in the fourth quarter results. Revenue of $22.1 billion matches the average analyst estimate, but adjusted EPS of $5.41 does exceed the consensus estimate of $5.34, and a lot of that, again, comes down to cost cutting. So to that end, FedEx is reducing, or I shouldn't say reducing, it's giving a 2025 CapEx forecast of $5.2 billion when analysts were looking for $5.5 billion. So we go back to that idea that FedEx is very much in cost control mode, as it has been for the last few years.
And they've been referring to these as permanent cost reductions too. So that gives you a sense of where the new CEO's head Mohammed is at is now, he's about 2 years into this job. And really, we talk about the consolidation, taking basically that air unit and that ground unit, kind of making them one, hopefully to provide more efficiencies. And the company also says it's going to throw a little bit of cash, I guess, back to investors. An extension here of that stock repurchase program, now a $2.5 billion repurchase program.
All right, and also UPS shares gaining on that as well. So sort of lifting all boats, that tide lifting all boats, considering that the Dow transports were also down a little bit today as well.
I want to bring Ellen Hazen back into this conversation, Chief Market Strategist over at FL Putnam. And Ellen, I mean, I know you haven't had a chance to see the numbers here, but we all pay attention to FedEx, not just for what it means for that company itself, but maybe a barometer on where we are in the economy, the health of the consumer, the health of businesses, to be sure as well here. As we head deeper into 2024 here and start to look ahead to next year, do you have a lot of confidence here that economic conditions, at least here in the U.S., are going to remain favorable?
I think that economic conditions in the U.S. look pretty favorable so far. We have seen a little bit of weakening in the labor market, not very weak, but a little bit of weakening around the edges. And of course, when the labor market starts to weaken, that's what it looks like. It looks like very small changes. So it warrants examination. It warrants keeping an eye on it. It does seem to me, just glancing through the FedEx numbers fairly quickly, that this was partially just very low expectations.
Yeah.
And that's what can happen to a stock like that. So I'm not sure that I would necessarily interpret it as broader strength in the industrial economy. But I do think that the rest of this year depends on the consumer. It depends on jobs, and it depends on corporate profit growth. And right now we're seeing corporate profit growth look to be about 8 or 9% for the third and fourth quarter. And those numbers have been fairly stable over the last several weeks. And so for right now, I think it's a holding pattern. I think it's steady as she goes into the third and fourth quarter for this year. And my biggest caveat that I've been saying for a while is that with the market already up 15% this year, it's going to be hard for it to get up a lot more because that's already a very good year.
All right, Ellen, great stuff. Got to leave it there. Ellen Hazen, Chief Market Strategist over at FL Putnam. As of course, we move away from those closing bells. After hours trading, the two biggest movers are the two biggest stories. FedEx shares up about 10% here in after hours trading on the back of its earnings. Rivian up more than 30% on the back of that news about a Volkswagen investment. A deeper dive into both of those stories in just a second, right here on The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostick. Scarlett, we just got those FedEx earnings just a little while ago, and at least based on the post-market reaction here, investors seem to like what they're seeing.
Well, in part because it delivered on what it was supposed to, and expectations might not have been too high for this company.
Yeah, well, they gave an annual profit forecast that I guess pleases some people, a little bit of a return to revenue growth. Remember, they've had several quarters of declining revenue. Let's get right to Lee Klaskow over at Bloomberg Intelligence, who covers this better than anyone else out there. And Lee, I know coming into this, we had low expectations, a stock that was basically unchanged on a year-to-date basis here. But when you look at the guidance that they're giving for this new fiscal year, and well as some of the commentary that they're talking about with cost reductions here, does this sound like a turnaround to you?
It sounds like they're in the midst of a turnaround, and that's the really key here. And it really seems like they are executing on their plans. FedEx, a while back, had some issues with its execution of its strategic plans. Now it seems like it is really driving those costs out of its network. It's really focused on creating a new network for the future, really, because the type of freight that company is ingesting into a system has changed considerably over the last 5 to 10 years. Now, because of the growth of e-commerce, it's B2C, it's packages going to people's doorsteps versus, packages going from law office to law office. Packages to people's homes are a lot more expensive to deliver, and they're trying to kind of change the way they operate, where they're integrating parts of their networks where previously they were completely or mostly independent, that being their air network and their ground network. And now, you're seeing that being integrated, which is taking out significant costs in their business.
Right. You're referring to the consolidation of the express ground and services units. Lee, what does it mean then when we get a headline like we just did about FedEx assessing the role of FedEx Freight in the context of consolidating those different units?
Yeah, to be honest, I haven't had the chance to read the whole release this afternoon, but I would be surprised if it wanted to get rid of FedEx Freight, just because of the fact that it's a very good business. It's a less cyclical business, if you will, than maybe its parcel business. Right now, that industry is extremely consolidated with significant pricing power. We expect LTL carriers, less than truckload carriers, which what FedEx Freight is, to generate pricing of in the mid digits in terms of price increases. So. Again, I can't really speak to it because I didn't read the full release yet in the process.
Yeah, it's a scintillating release, a lot of jargon and everything else in it. Lee, in all seriousness, though, I am curious just about kind of the broader read. I know we were talking about this turnaround at FedEx, but is there anything we can extrapolate out of some of these numbers into some of broader economic conditions here? Is this sort of a support? Is there support, I should say, from the economy, from consumer spending, from business spending?
Yeah, I mean, net, I think it's kind of steady as she goes in terms of the economy. You are seeing some volume growth here, which is obviously a positive for the overall economy. FedEx touches a lot of businesses, and like I mentioned earlier, their market shift. Market has kind of shifted more towards that B2C business. And so, what it is showing you is probably a more or less a resilient consumer. And that's really where the growth is going to come over time, in our view, more so than its other businesses, especially, where we're in the economic cycle with low industrial production expectations and an ISM below 50.
FedEx has been a story centered around cost cuts for so long, and of course they're still continuing with it. I just wonder at what point FedEx starts to cut into bone, not just get rid of the fat, but start cutting into the bone. Have we reached that point yet?
Oh, goodness, no. FedEx has a long way to go in terms of cutting out some of that fat. Probably before the last management change, I think the organization was extremely bureaucratic and top heavy. I think they're going about reducing headcount and really streamlining their operations. And the fact that they're willing to put the ground and air network, kind of combine them when it makes sense, that's a huge diversion over what the company used to say, call it 5 years ago, when they said there was a lot of value to have those separate networks. I think they finally realized that maybe the value is, combining those networks as much as they possibly can. And they're also changing the way they do their air network, where they're calling it, they're having a color-coded strategy where they have purple tails, orange tails, and white tails on their planes, and the purple tails are those shipments that are going, that need to be there the next day. Orange is kind of like, more deferred service, and white is freight that's going to go on third parties, and that will make a much more efficient network and better use of very expensive assets, those airplanes.
Lee, thank you so much for giving us your instant analysis. Lee Klaskow of Bloomberg Intelligence. And again, Romain, this is a stock that has been unchanged this year, so expectations were not exactly high heading into this. But this is a phenomenon. I was just looking on the Bloomberg. This is the great thing about having a Bloomberg terminal. 15% gain in after-hours trading. If that translates into the cash session tomorrow, and they close at that level, that would be the biggest one-day gain for this stock as a public company, which went public back in 1980. All right, well, we'll see if that actually shakes out. How's that for low expectations? Yeah, last time after its earnings, it was down about 4% since the last earnings report, because the third quarter sales missed estimates, and people are really wondering in terms of the macro economy what the outlook is here. All right, coming up, we've got the top three, where we focus in on the top three movers and shakers at the center of the day's big stories. This is The Close on Bloomberg. It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Bernard Arnault. He is Europe's richest man, and he is said to have acquired a stake in the parent company of Cartier, and that would be Richemont. This is according to people familiar with the matter. Now, Romain, to be clear, this is his family's portfolio of investments, not LVMH, where he is CEO and chairman. Yeah, although sometimes that gets a little intertwined there, which has sort of rankled some investors in the past here. But yeah, I mean, this is obviously guys setting up his real succession planning here. I'm just speculating, but this appears to be part of that. Yeah, perhaps. And you talk about the lines blurring. 14 years ago, LVMH bought a stake in Hermes and quietly built that stake up to about 23% through equity derivatives. And of course, the Hermes family pushed back. Or the family behind Hermes. I don't think they're the Hermes family anymore.
Yeah, great story on the Bloomberg terminal. Encouraging everyone to go read that. A person I'm keeping an eye on. Remember Julian Assange? Well, he's back in the news, and at least for him, for a good reason. The WikiLeaks co-founder out of jail and now en route to the U.S. territory of Saipan, where he will plead guilty to leaking U.S. national security data. This is part of a deal with the DOJ that ends a 15-year-old battle over his prosecution that should allow him to return home to Australia. The expectation here is that whatever jail time he gets, he'll basically get credit for time served, which basically effectively means he's going to be a free man once all this is taken care of.
Yeah, he's 52 years old. What do you think he's going to do now?
I don't know, but I mean, it's kind of hard to believe. I mean, 15 years of this?
I know.
I can't believe it's that long. Where's Edward Snowden? What's he doing?
Yeah, that's a good question. Maybe they'll start hanging out on social media. All right, the third person on today's watch list is AOC. On primary day in New York State, the New York Democrat and founding member of the squad has evolved from firebrand to pragmatist. She is actively campaigning for President Biden, serving as his emissary to young and minority voters, most recently in Nevada. Well, some would say that she's becoming more of a pragmatist. She's made peace with Nancy Pelosi after a rocky start.
Yeah, I remember they hated each other at one point, right? Or something like that. Or at least
now they're singing from the same hymn book for the most part.
Yeah, it's kind of weird. I mean, a politician being a pragmatist. I mean, you know, what a world we live in these days, you know.
As opposed to an ideologue?
Yeah, well, it'll be interesting to see the results, particularly out of that these races in New York, which have become very politically charged, and a lot of people think they could be a barometer for the more general election in November.
She's facing a primary challenger as well, although that's more of a long shot.
Yeah, and of course, one of her squad, Jamal Bowman, who represents parts of the Bronx and I think parts of Westchester too. He's not polling well, so it'll be interesting to see how things shake out for him. Those are our top three here on the day. We want to get back to a top story that broke just after hours involving Rivian. Look at the shares. In after hours, trading a 35% jump on the back of news that Volkswagen plans to take a $5 billion investment in the company. David Welch joining us right now from our Detroit bureau. And David, this seems like it came out of the blue, but did we have any hint that this was coming? Was Volkswagen always kicking the tires on this?
We didn't have much of a hint that it was coming, but Rivian was clearly out there raising money and they needed cash. They've been burning cash. And given the low production numbers that they had, it really didn't seem like they were going to get to cash flow positive anytime soon. So they needed money. There were maybe financial partners out there they could have gone with, but this helps them a lot. And it also helps Volkswagen, by the way. But it helps Rivian because now they have a partner, big auto company that has production, has engineering, has a big parts bin that they can get to for non-EV kind of parts. So maybe they can lower their costs a lot faster than they could have going on their own, selling, building 50,000 vehicles a year. And for Volkswagen, they have the Scout unit.
Why is Volkswagen doing this? I thought they had their own EVs.
They do, and they have their Scout unit that's supposed to make electric trucks, but they might get access to Rivian's pickup and SUV platform, which allow Volkswagen to get into those segments pretty quickly if that's what they want to do. We don't really have the details of the industrial logic behind this, but you can see where they could have a lot of joint manufacturing, joint engineering kind of ventures where they can both lower their engineering costs, get vehicles to market faster. And this is something Volkswagen does. They own a lot of other brands besides Volkswagen and Audi. Well, they've got Bentley, they've got Lamborghini, they've got a bunch of other European brands as well. And, Volkswagen's always been the kind that acquires. They had a venture for a while with Ford doing self-driving vehicles. So this is a company that likes to play with others and likes to buy other brands. They're not going to buy Rivian, it doesn't seem like, but $5 billion over time, $1 billion to start. That gives Rivian a pretty good injection of cash to get going and a pretty long lifeline here if the venture takes hold and they get the other $4 billion, I should say.
So I'm looking at Rivian. Of course, it's backed by Amazon, which has a 16% stake in the float. But also Ford Motors has a 1.1% stake in Rivian, which I recognize is not a ton. But does that create any potential conflicts with Volkswagen?
Not really. I mean, we'll see what happens with Ford. You remember Tesla in its early days had both Toyota and Daimler and Mercedes in there, and both of them sold their stakes and made pretty good money on it. Not as much as they would have if they held on to them for a very long time, but they were both in there doing some joint engineering, sharing parts with the company. So, I would imagine we'll see what Ford does over time. Maybe they sell on this. Maybe they get more involved because Ford and Volkswagen have had relationships and still do. So, there are a lot of ways this could play out, but in the time being, I think merging up the engineering, the part sharing, all that industrial stuff that's kind of behind the scenes will be a big help for Rivian, because you can't get to cash flow positive without lowering your costs and boosting production, and Volkswagen might be able to help them with a lot of that stuff.
I'm curious, though, about the potential of the next phase. It's one thing to get sort of this lifeline of money to keep things afloat here, but we have to compare it, of course, to Tesla, because they are still kind of the dominant player in the EV space, and a lot of the secret sauce there was they kept, or at least they were able to get production costs low. The methods they used to do that, that's questionable. They also built out a charging network that also made it attractive here. Is Rivian and this money that they're going to get from Volkswagen, is that going to give them a shot and maybe building out that infrastructure as well?
It does. I mean, look, at a minimum, it just keeps the company going and allows them to keep developing some of their future models, and they will be able to lower costs. Everybody is going to have to work to build out this charging network, because it's not clear, given all the turmoil at Tesla. They do have relationships with other car companies where they're going to share their charging standard. But given all that's happened, a lot of people are kind of wondering what's going to happen next with that.
Right.
And the car companies have their own venture to expand the charging network across the U.S., and that has to happen. All that takes money, and that's what they're going to get.
Yeah, David Welch, thank you so much for the instant reaction there to the news that Rivian has formed a joint venture with Volkswagen. Up next, a wrap of day one of Bloomberg Invest. We'll have all the highlights. This is the close on Bloomberg.
Just about 4.5 months until we get to the U.S. presidential election, and this Thursday, Joe Biden and Donald Trump will be holding their first debate of the election cycle. Some of the big money on Wall Street already pitching its own vision for a Trump America. Business figures led by hedge fund billionaire Paul Singer pouring $200 million into a New York think tank to wage a war on wokeness. Bloomberg's Simone Foxman joining us right now, who co-wrote the story, and a word that's verboten on my lips, unless you can actually define it here. Tell me about what Singer is doing. I mean, we know he's been a big backer of Trump the last election cycle, this election cycle, but the amount of money he's raising, and more importantly, where that money is being funneled to, that's a little bit different than the last time around.
Well, this think tank is the Manhattan Institute. Mm-hmm. It's been around for several decades, but it's only been under Singer's chairmanship since 2008. And in the last decade, it's raised close to $200 million, and it has a newer president whose name is Reihan Salam, who's been particularly interested in having his fellows be activists, get their policies noticed. And chief among those policies is some of this anti-DEI rules, anti-racial is the way they describe it, against putting too much emphasis on identity politics. And they've been extremely successful at getting laws, anti-DEI laws passed at a state level. Some 11 states, they claim credit for having those laws put into place. So that's where Singer's money and interest have been focused, because he's had a hard time, as have a lot of people on Wall Street, getting behind Donald Trump. He initially backed Nikki Haley, but everyone really seems to be pushing on walls. A lot of these
What
big
happened to
players.
Nikki Haley? Is she around? Is she like on the vice president short list or anything?
Probably not, right?
Yeah, she's not considered a high probability there, but she did, I guess, go and endorse Trump.
Yeah,
she did already.
Somewhat reluctantly and
of
somewhat
course.
way after the fact, right? I love one of the quotes in your story. A former trustee of the Manhattan Institute said, "Let's apply Wall Street analysis to social issues." That's kind of how this think tank goes about things. You mentioned some of the social issues they talked about, yet you also mentioned the reluctance and the complicated relationship a lot of the principal players have with Donald Trump. So How do they characterize this think tank? Does it tilt to the right? Does it tilt to the left? I mean, what do they say about it themselves?
So Salam, the president, has said this is not a left-leaning or right-leaning think tank. They want to appeal to the urban centrists, they feel, who don't really fit in either political party. I think the challenge is that in this politically divided climate, it's very hard to appeal to that group of people, and instead a lot of the appeal here has been to chiefly Republican politicians, especially at the state level. This was a think tank that was really formed to focus on Manhattan, New York City issues. I think what's happened in the last 5 years, though, maybe even 10 years, is it's really started focusing on issues that are much more relevant outside of New York City. They're not necessarily these urban issues. Yes, they care about things like crime.
So it was originally supposed to be on New York City issues?
Well, and urban issues generally. Issues. So, the broken windows, policing, these are things that they espouse. But more recently, it's focused on culture war issues, K-12, gender identity education, DEI, as I mentioned. Should you give subsidies for EVs, immigration, those sorts of things?
Fixing the MTA.
No, that's New York City based. That's universal. All right, Simone Foxman, thank you so much. Again, this group is drafting model legislation that state and local governments have been using to get their own legislation across. Thank you so much. All right, it has been a big day of big guests at the Bloomberg Invest Conference in New York's Financial District. Here are a couple of the highlights. Let's listen.
We think there's a big opportunity in credit.
There is huge investor demand.
Because the returns are higher, now everybody wants access to it and is trying to get into it at the same time.
The credit cycle is quite mature.
What we want to do is just be all things credit.
We do expect there to be some challenges ahead.
Private credit has been touted as this amazing thing, almost like NFTs or, ChatGPT.
I don't think that the boom in private credit all of a sudden suggests that private credit is bad asset class.
I think it would be impossible for us to ignore private markets and not think that there's a large opportunity set.
We don't think the very record tights that we have on credit spreads are reflective of some of the real challenges we have in the economic backdrop.
I look at it like this amazing force that will have hiccups in the years to come.
And the woman behind it all, Bloomberg's Sonali Basak, has been hosting panels at the Bloomberg Invest Conference all day long, and she joins us now. Sonali, we heard some of the highlights from the panelists there. I know you interviewed a number of them. There are a couple of key themes that came across. Credit's one of them. Talk to us about your impression of what the expert panelists were saying about the state of the economy and the state of the U.S. as we head towards the elections.
Yeah, it's a great question, Scarlett. And they say spread makes a market. This whole idea that you have all of these investors and they can't really make up their mind on private credit as a whole or even public credit at this point in time. What is clear is there seems to be a sense that volatility or at least uncertainty will be a key feature going into the U.S. election cycle and maybe significantly after. Paul Taubman, the CEO of PJT, for example, really threw a lot of water on a significant rebound here in M&A markets, for example, or even private equity deal making, with the idea that things might not really come to a stable point until you have one administration or another in a more solid footing into next year. And so 2025 might be the year that you see people have more exuberance, maybe.
Yeah.
How do you pair that with the fact that potentially there are cracks in the market elsewhere?
I thought it was interesting, Sonali, the conversation earlier with Cliff Asness, where he kind of looked at it more of the view that I don't know if he said markets were broken, but certainly they were having some issues despite all these technological advances. Explain what he was talking about.
Yeah, that was pretty fascinating, wasn't it? Because this is somebody who really grew up under the efficient market theory under Gene Fama, and he's telling you that the markets are less efficient today than they were when he started his career 3 decades ago. He gave 3 reasons: the impact of prolonged low interest rates causing distortions and driving things up to maybe not bubble territory anymore, but pretty close to it, passive investing and very unknown effects around passive investing, and a part of it also being not retail investment per se, but this meme stock frenzy and retail investors driving certain stocks up to levels that may not meet the fundamentals, and that is making an investor's job harder. It's also creating opportunities for places in value for things like Malaysian palm oil. He went on about that for a while, but the point is they've gone global to look for that value.
All right, Bloomberg's Sonali, Basak, great job. Thank you so much. And be sure to tune into Bloomberg Television tomorrow for another big day of big guests from the Bloomberg Invest Conference. All right, let's take a look at how the public markets closed on the day. A little bit of a yawner, Romain, in that we kind of unwound some of the unwinding of the Mag 7 trade yesterday. It's like we went back to the normal state of things, which is the Magnificent Seven continues to rally.
Right. I mean, you saw all those names move higher. Obviously, NVIDIA was kind of at the top of that list, up 7% here on the day. But then you look at the bids that came into Alphabet. Even Tesla was up about 3%. And Meta Platforms, for some reason, which I think everybody forgets about in this AI race for obvious reasons, up 2% here.
You know, they have a lot of commercials on TV now about AI.
I know. They want to make us feel good about AI and not like it's going to, ruin our lives.
You can ask all kinds of questions when you're on Facebook or on Instagram, apparently.
But the flip side of this, and we didn't really get a chance to talk to this because of some of the other breaking news here, but that big decline we saw in Pool Corp today, and obviously, you think, okay, a pool company, what does that have to do? But I mean, their guidance that they gave yesterday was all about this idea that we're just not doing home renovations. People aren't spending on those big ticket items. And then we saw that big drop, not just in Pool Corp, but in Home Depot, Lowe's, and a lot of the other areas that you would spend money on.
Yeah, the real economy and discretionary spending,
Absolutely,
right?
Yeah.
Never mind what we search on Facebook or Instagram. All right, this is The Close on Bloomberg.
All right, a big focus on AI at the Bloomberg Invest Conference, and the backdrop to that, though, is still some concerns about China. OpenAI today taking additional steps to curb China's access to AI software, with the Microsoft-backed startup reportedly sending warnings to developers across China about plans to begin blocking their access to its tools and software starting in July. Bloomberg's Jackie Davalos joining us right now with more details. Jackie, what do we know?
Well, we do know that these developers in China will not have access to OpenAI's technology starting in July, as you mentioned, Romain. Now, local media reported earlier today that this really originated with some screenshots of a memo OpenAI had sent developers that were circulating, and that basically said that this access was going to be curbed. The company actually confirmed this decision to Bloomberg News today as well, and noted that, quote, it's taking additional steps to block API traffic from regions where we do not support access to OpenAI services. Now, remember, OpenAI has been taking more decisive action this year when it comes to curbing access from actors it believes are using its technology for nefarious purposes. In May, it released a report where it noted that Russia, Iran, China, and Israel were using OpenAI to manipulate public opinion. So this is just the next step in escalating that policy even further, Romain.
I'll take it from here. Jackie, thank you so much for setting that up for us. Jackie Davalos joining us there on OpenAI and China. Let's stay with AI, but through the lens of the public sector. Booz Allen Hamilton is the #1 provider of AI services to the federal government. Horacio Rozanski is president and CEO of the firm, and he joins us now to discuss the management consultancy's transformation to a tech consulting firm. Great to speak with you, Horacio.
Thank you for having me.
I know you were in town to ring the opening bell at the New York Stock Exchange. Can you give us a little more context? Briefly explain to us what specific role Booz Allen plays in the government adopting more AI into its operations.
Absolutely. So Booz Allen has been around for 110 years. And so because we're celebrating that, I had a chance to ring the opening bell today, which was super cool. We're the people that focus on accelerating the use of technology into the federal government. And it's not just AI, it's a whole range of technologies. We help develop technologies that keep our men and women in uniform safe and bring them home safe, that hopefully will help deter the next conflict, that give our veterans their benefits faster. And even if you're booking a campground at a national park, we've developed that technology as well. We started
Well, I'm curious too, just to talk about the role of Booz Allen Hamilton in this, because whenever we're talking about AI, we talk about OpenAI, some of the more commercial applications of this. Sure. But there's been a lot of talk about competition, particularly with China, security risk, particularly with China, and the idea that the government, and for that matter, the government contractors like yourself, need to have maybe a little bit more of a prominent role in the development of this. How much of a role do you have in this relative to someone like OpenAI?
So we work very closely with our clients to take all of this technology that's been developed in the private sector and figure out whether it can be applied in the public sector, how it can be safely applied in the public sector, and then help them do it. That includes OpenAI. You know, we started talking about large language models in 2017, 2018, and people thought we were crazy. And here we are.
Yeah.
So when you talk about AI, you're applying it to the battlefield, for instance, in outer space with satellites. You know, it's something as pedestrian as our tax returns at the IRS. What is your observation with regard to how the federal government actually applies AI into its operations? Is it centralized, or are agencies moving ahead on their own without the real benefit of sharing knowledge and sharing best practices that could break down silos and allow everyone to not make the same mistakes?
So it's a little bit of each. This is a massively complex undertaking because you're taking a technology that was developed perhaps for consumer use, and now you're trying to use it in national security missions where people could actually die if the technology gives you the wrong answer. And so it needs to get applied with much more care. It needs to be thought through much more carefully. And each agency has its own different set of needs. If you're using it in space, you're going to have different needs. And if you're using it to do a customer-facing thing for the American people here on Earth. So each one of these is going to go its own way. Having said that, there's a fair amount of cross-sharing and cross-understanding, and companies like ours actually help do that because we work across the spectrum of the federal government.
Have you had to hire a lot of new folks for this effort?
A lot.
A lot,
A lot of hiring, a lot of training of our own people.
Yeah.
We think right now we have about 2,300 AI professionals.
Wow.
Across Booz Allen. Our total workforce is about 34,000, so it's a pretty good chunk.
And most of those are new people, or?
Some and some.
Yeah.
You know, one of the things we pride ourselves of is we train our people. So if you came in as a programmer and you had an inclination, we turn you into a data scientist. Maybe you became an AI professional. We have an internal effort to train at least 10,000 people, hopefully everybody, in at least the basics of AI, because it's important. I took the training. We all need to know more.
Understand it, yeah.
I mean, it's easier for Booz Allen to train up talent, but what about the federal government? Because at some point you have to let them kind of do their thing as well. How challenging is it for them to be able to hire the right talent to implement this technology?
It's harder. They have more limitations than the private sector does. Having said that, they also have a huge advantage, which is these missions really matter. You know, when you're going to do one of these things where you're going to help our men and women in uniform come home safe, young people want to flock to that mission. And if you give them the opportunity to do it and you give them the tools to do it with, they're going to show up.
All right, Horacio, thank you so much for joining us today.
Thank you.
Horacio Rozanski is president and CEO of Booz Allen Hamilton. I remember it from long ago when it was a management consultancy, and now it's become so much more.
It has evolved
It
into
has
a
evolved.
behemoth, yeah, that is for sure.
Well, we're going to continue the AI conversation tomorrow because I'll be sitting down with Derek Waldron, Chief Analytics Officer at JP Morgan Chase at Bloomberg Invest. We will air part of that conversation right here on The Close.
All right, but stick around. We're not done just yet. We're going to set you up for some of the big market moving events over the next 24 hours. This is The Close on Bloomberg. All right, welcome back. Let's have our muni moment right now because borrowing costs and pent-up infrastructure demand are just some of the factors driving a boom in the muni bond market. So far this year, there have been a record 27 deals of at least $1 billion, topping the previous high of 26 debt sales of that size in 2020. In its latest outlook, Nuveen says the municipal yield curve is sloping upward and paying investors more for lending for longer. Here in studio for more on today's Muni Moment is Dan Close, the head of municipals at Nuveen. Welcome to New York.
Thank you so much.
We'll get to that in a second, but let's start off with these mega deals here. Why are these deals so big this time around?
Yeah, certainly. I mean, we've seen, as you noted in Joe Isaac's comment, 27 deals so far. In this week alone, we have Los Angeles GOs, we have State of Washington GO, and also third deal with Mask, all going in bringing these $3 billion deals. And so there's three primary reasons we're seeing these mega deals. First and foremost, just we're at a lower interest rate than we were near our local. So end of May compared to where we were in August, September, October of last year, So it's not just the absolute rate. Issuers on the muni side want to have confidence as far as execution levels go. So not having the range of rates too has given a lot of confidence. The second is we're starting to see a lot of pent-up infrastructure that was put off, higher construction costs, not able to come to market at the ideal time.
Yeah.
And last, and it's an interesting factor, really only in munis, but 4 months out from the election, a lot of issuers want to avoid getting in front of the election, talking to local issuers, talking to bankers, underwriters. There's this desire to not have anything to do with the 2016 election and bring up the issuance as much as you can. So these mega deals are all part of it, but certainly having 30 deals, and last week JFK Terminal 1 had a $2.5 billion deal. It's just part of what we're seeing in the marketplace of much larger deals coming and a lot more supply coming compared to the same time as last year.
Well, speaking of potential supply coming, and you're being in New York City, the city was supposed to start a congestion pricing plan at the end of this month that would have raised $1 billion in annual revenue and then issue bonds based on that revenue to generate another $15 billion. Now, because Kathy Hochul, the governor of New York, called the whole thing off, there's a pause on it. The MTA says it would have to move up their issuance of debt.
Right.
What kind of demand do you anticipate for muni bonds from the MTA?
Well, it is interesting because that congestion pricing was going to raise more than $1 billion. MTA was going to lever that to get $15 billion or so of issuance for longer term capital project, rolling stock and the like. But, the MTA does have a lot of different funding options. They could go in and they have fare box receipts. They have direct appropriations from the state of New York. They can also go in and they're actually tapping the market this week with a deal that leverages the bridges and tunnels tax from the Triborough. So, they do have other options, but certainly not having that congestion pricing is going to impact their ability to go forward with their capital plans. And we think that they're going to have to go in and use other sources of revenue until which time we see that congestion pricing come back.
Does that mean they would have to pay more as well? I mean, if they did come to market with something, not having that sort of that sort of tailwind of the congestion pricing?
Not necessarily, because the most expensive debt for them is their fare box debt. It's their lowest rated debt, but certainly going and issuing with the Triborough Authority gives them some pretty cheap financing because that's a higher rated entity. The congestion pricing, I think they're so excited about because generating that $1 billion, you could really lever that and get a lot of capital projects done with that.
Yeah, and we should just be pointing out, and most of the reporting here at Bloomberg, at least, is that this is more of a temporary pause
for sure,
rather than them just scrapping it. And
that's right.
I don't know if you've ever ridden the New York City subway, but we need the money.
But it's definitely paused through the election, so we're talking until at least early next year, provided the economy allows for it. How would you advise the MTA to move forward if they were to come to you for advice on this?
Yeah, I would certainly just suggest, there's a lot of really good things that could come from the congestion pricing. You have that knock-on effect of, we would think that more people would begin riding public transportation. We would think that we'd have more cars off the streets. So there are certainly a lot of very good impacts from this. And certainly the MTA, I think, could go in and get this. They just have to get past this election.
All right. Always a great conversation with Dan Close. He heads up the municipals team over there at Nuveen. Our Muni moment here on the day as we close out the show. We'll push ahead to some of the potential market-moving events over the next 24 hours, and that includes, Scarlett, day 2 of Bloomberg Invest. I'm told you're going to be a star of the show tomorrow.
Well, I'll be one of the people interviewing the stars of the event. Michael Arrighetti, Ares Management CEO, Ray McGuire, the President Lazard, and Rebecca Lynn, the Canvas Ventures co-founder, are among the highlights we can expect tomorrow.
Earnings also tomorrow as well. General Mills before the bell, and kind of a forgotten player maybe in the AI space after the bell?
They don't want to be a forgotten player. They want to be like a key player here.
Yeah, but it's just like memory, Micron, right?
Micron, but
everyone's saying all this data, you got to store it somewhere, you got to memorize it, and that's what they do. Okay.
And there's a role for them here too as well. Also, in terms of eco data, we get the mortgage apps on a weekly basis, which kind of tees us up for the new home sales at 10 a.m. We know there's a lot of demand, and we know that rates have stabilized, but they're still pretty elevated.
Yeah, well, we'll see what those numbers look like coming off the results that we got last week out of a couple of those home builders. Not all that confident there. I don't know how excited you are for this, Scarlett, but at 4:30 p.m. New York time, we get those bank stress tests.
I think they're going to pass.
That's a bold call by Scarlett Fu here. They will pass. Of course, we will have full coverage right on the close as it breaks, just in case one of them doesn't.
Yeah, just
pass.
in case.
Also tomorrow, in the world of sports, Scarlett, we have the NBA draft where everybody gets a look here at the future crop of multimillionaires.
Do you think LeBron James Jr. will be drafted? That's the question.
Yeah, but not for the right reasons. All right, that does it for the close here on Bloomberg, but stick around. Balance of Power coming up next, and be sure to join Scarlett and I tomorrow for all your market moving coverage right here on Bloomberg.